Your main objective in this part of your studies is to get to grips with the basic concepts of interest rate risk. However, to understand this particular financial risk, you need to be able to identify and calculate the different components of bond return. So this is where we begin. By now, you are familiar with the concept of holding period return, applicable to any financial asset, whether it is a share or a bond or something else. What you are about to see does not override the universal holding period return principle in any way. However, in order to understand fixed income risk, a bond's holding period return must be divided into two components. Firstly, there is a capital gain or loss element. This is determined as the difference between the selling price of the bond, which happens at its market price, and its carrying value. The key point to notice at this stage is that the bond's original cost does not appear in the equation. You are already comfortable with the tools needed to calculate a bond's market price using the current market yield. Exactly the same process applies to calculating carrying value, except that this is done using a different yield. The second component of bond return arises from the fact that bonds usually pay intermediate cash flows called coupons. Until now, we have not concerned ourselves with the question of what actually happens with those cash flows. However, it is now time to answer that question with the insight that the coupons are reinvested and therefore they generate a second income stream. Before continuing, a side note on yield to maturity. The term market yield is often used interchangeably with yield to maturity. This is mostly acceptable, but you need to be careful when dealing with capital gain or loss situations. There is a current yield to maturity and an original yield to maturity. Current yield to maturity, also known as current market yield, fluctuates during the bond's holding period in response to any changes in market conditions. Original yield to maturity, on the other hand, remains fixed at whatever rate applied on the date the investor bought the bond. Current yield to maturity is used to calculate market price in the capital gain or loss equation. Original yield to maturity is used to calculate carrying value. Once you have identified the correct yield to maturity, you apply the now familiar tools, usually using the TVM functionality of your financial calculator to calculate the bond's value, whether it is market price or carrying value. As always, keep an eye out for cases of non-annual periodicity, especially the very common semi-annual pay bond. The calculation of the carrying value of a bond will be familiar to you if you have done an intermediate accounting course on financial instruments. The accountants apply exactly the same principle as we use in finance. We even use much the same terminology as them, referring to carrying value as an amortized cost. As indicated on the screen, the key principle is to remember to use the original yield to maturity and not the current market yield. Apart from that, there is nothing new, and you will get the right answer as long as you also remember the time passes, and with each passing year, the time to maturity gets less and less. To emphasize the point, the carrying value of a bond changes only with the passage of time and not in response to current market conditions. In your reading, there is a detailed example showing how the carrying value of a discount bond increases over time until it reaches exactly par at maturity. Similarly, the carrying value of a premium bond is amortized over time until it, too, is exactly par on the last day of its life. Notice that amortization can be positive or negative. This process is, for obvious reasons, called the pull to par effect. Turning attention to coupon reinvestment return, an often ignored assumption of any application of the internal rate of return method is that it assumes that all intermediate cash flows can be and are reinvested, producing an extra return equal to the IRR. All yield to maturity calculations assume exactly the same thing. However, the reality is that market yields will fluctuate during the term of the bond. If a bond's current market yield goes up, then the reinvested coupons will earn a higher return. If yields go down, then coupon reinvestment return will be lower. This brings us to the crucial insight about interest rate risk. If the market yield goes up, for example, we have just noted that this will be good for the investor because the reinvested coupons will bring in more interest income. But the same change in yield causes the market price of the bond to decrease because price and yield are inversely related. Clearly, this is bad for the investor. Therefore, the market price effect and the coupon reinvestment effect of any change in market yield work in opposite directions, and it is this that is central to your understanding of interest rate risk. Finally, we return to our starting point by taking a brief look at the calculation of a bond's holding period return. This has a special name, being realized or horizon yield, and it is calculated using the equation on your screen right now. This is the total return over the investment horizon on a bond, including both capital gain or loss and coupon reinvestment return. However, as I observe in the cautionary note, realized yield does not provide an automatic mechanism for separating bond return into its two components.